Chicago burned, insurance markets flourished. The Great Chicago Fire of 1871 was one such nightmarish scenario. It burned for 2 days and destroyed more than 3 square miles, about 200 acres of downtown, leaving over 100,000 people homeless. But it wasn't just about the destruction, it also sparked an entire industry. This disaster played a significant role in the development and expansion of insurance markets, as businesses and individuals sought ways to protect themselves from similar catastrophic losses in the future. Here's your stake. If you own a home or run a business today, chances are that you have benefited from the innovations spurred by the Great Chicago Fire of 1871. That's because this event led to new regulations and the development of insurance products that fundamentally changed risk management practices forever. Let's start by understanding what happened in Chicago back then. The city was made mostly of wood, houses, stores, everything. On October 8, 1871, a small fire started and quickly spread. Strong winds fanned the flames, making it impossible to contain. By the time the blaze ended 2 days later, nearly 4 square miles of Chicago were in ashes. Now here's the real question: how did people rebuild? At the time of the Great Chicago Fire in 1871, there were no major insurance companies operating in Chicago, so most residents lost everything. However, this tragedy set off a chain reaction that led to the development of new financial tools for disaster recovery and risk management, including the expansion of local insurance markets and the establishment of policies to protect against future disasters. Insurance is all about sharing risks. You pay a regular premium so that if something bad happens, you do not suffer the full loss yourself. Prior to the Great Chicago Fire of 1871, insurance was primarily used for ships and crops rather than buildings or personal property. The fire significantly increased demand for building and homeowners insurance as people sought protection against similar catastrophic events. After the Great Chicago Fire of 1871, people recognized the need for better protection against disasters. This led to the creation of new insurance companies and regulations aimed at improving risk assessment and management. Insurance agents began offering specialized policies tailored to protecting urban properties constructed from materials like wood or brick. One key figure in this story is a man named Benjamin Wood. He co-founded the Board of Trade and Transportation Building Association, which later became Continental Insurance Company, one of the early firms focused on rebuilding Chicago after the Great Chicago Fire of 1871. This company played a significant role in setting standards for building materials and city planning to prevent future disasters. Now here's how insurance companies work. They collect premiums from many individuals who purchase policies. These funds form a large pool that's used to pay claims when needed. If you have an insurance policy and your home is damaged or destroyed by fire, the money in this pool can help cover the costs of repair or rebuilding. But there's a catch. Insurance isn't just about compensating for losses, it's also about prevention. Following the Great Chicago Fire of 1871, insurers began requiring fireproof materials like brick or stone for buildings they insured. They also advocated for better city planning and improved firefighting equipment to prevent fires from spreading. So how did insurance policies change daily life after the Great Chicago Fire? First off, homes became safer as building codes got stricter, which meant fewer fires overall. But it didn't stop there. Insurance companies began offering coverage for additional risks such as theft or natural disasters, anything that could cause significant financial loss. Subject: the Great Chicago Fire and the rise of insurance markets. Passage to fact check. Fast forward a few decades to the 1870s. The Great Chicago Fire of 1871 devastated the city, but thanks to insurance policies, many families had some cushion against catastrophic losses. People with property insurance received payouts to rebuild their homes and businesses, helping to spur economic recovery in the affected areas. Now let's look at a concrete example. Imagine you're running a small store in Chicago before the Great Chicago Fire of 1871. You'd have limited protection if your shop burned down, as insurance was not widely available or affordable for many businesses and individuals at that time. But after the fire, you could buy an insurance policy that would help rebuild your business after a disaster. That means less financial stress when something bad happens, as you're financially protected against such risks. But it wasn't all smooth sailing. Insurance companies faced significant challenges in accurately assessing the risk associated with properties and pricing premiums appropriately. This led to the development of new actuarial models, using mathematical methods based on historical data to predict risks accurately. One such model is the Fire Insurance Map, which categorized different levels of fire risk for various parts of a city. Typically, darker colors like red indicated higher risk areas, while lighter shades like blue represented lower risk zones. Insurance companies use these maps to set premiums and guide urban planning efforts aimed at reducing future fires. Let's pause here. Why did insurance companies push for safer building codes after major fires like the Great Chicago Fire of 1871? It reduced their potential losses over time, saving them money and making insurance more affordable for everyone. Now let's shift gears a bit. How did this impact big businesses? Well, large corporations began to use insurance to manage risks more systematically. They purchased policies not just for property damage, but also for liabilities and employee health care. This meant that if something went wrong, they could cover the costs and continue operating without significant disruptions. Insurance became a crucial part of economic stability. For example, after the Great Chicago Fire of 1871, which destroyed much of the city and caused significant property damage, insurance played a vital role in helping businesses rebuild and recover. The policies covered various risks so that firms could focus on recovery rather than financial ruin. But here's an interesting twist. The same principles used for fire protection soon spread to other areas as well. For instance, health insurance began to develop as companies started offering health benefits to employees, which reduced the financial strain on families during medical emergencies. Now, let's circle back to today. You likely have a homeowner's policy or business insurance because of these early innovations born from the Great Chicago Fire of 1871. The concept is simple: pool money together and use it when disaster strikes, spreading risk among many participants instead of bearing it alone. Here's another angle. Consider how insurance impacts your daily life now. Whether you're renting an apartment, buying a car, or starting a new job, insurance is frequently a key component of these decisions. It's there to protect you from unexpected costs that could disrupt your financial stability and peace of mind. So here's the big question. Why did insurance become so crucial after the Great Chicago Fire of 1871? Because it offered a financial safety net for individuals and businesses affected by unforeseeable events like fires. Without such systems in place, recovery from such disasters would be much harder, if not impossible. Subject: the Great Chicago Fire and the rise of insurance markets. In short, the Great Chicago Fire didn't just destroy buildings. It sparked an entire industry that keeps our cities running today. From safer homes to better economic stability, insurance has become essential for modern life. And all because of a fire over 150 years ago, specifically in 1871. This is educational and historical, not financial advice. The Great Chicago Fire of 1871 ignited more than just embers. It set the stage for a revolution in risk management. Before the fire, property owners were largely on their own when disaster struck. They had to either rebuild from scratch or go bankrupt if they couldn't afford repairs. But after the flames subsided, insurance companies started offering policies that allowed individuals and businesses to share the financial risk of rebuilding in case of disasters such as fires or floods. This innovation was significant because it prevented any single individual from facing total ruin due to a catastrophic event. A key figure in this transformation was Benjamin Franklin, who played a crucial role in recognizing the need for insurance against large-scale urban disasters. In 1752, he founded the first fire insurance company in Philadelphia, not Chicago, setting a precedent for how cities could protect themselves from similar catastrophes. The Great Chicago Fire occurred in 1871 and spurred significant growth in the city's insurance industry following Franklin's earlier innovations. Insurance companies introduced innovative measures to prevent fires before they started. They sent out inspectors to assess risks and recommend safety improvements. For example, homes with wooden roofs were considered high risk, so insurers often required property owners to replace them with safer materials like brick or stone. This not only reduced the risk of fire, but also created a ripple effect throughout society, making buildings more resilient and contributing to overall public safety. Moreover, insurance played a crucial role in aiding economic recovery following devastating events by providing immediate financial relief that enabled businesses and individuals to quickly resume operations and rebuild. Without such support, recovery processes can be significantly delayed, potentially extending the duration of economic disruption and hardship. Today, we see similar principles at work across various forms of insurance. Health insurance helps cover medical expenses, auto insurance covers damages from vehicle accidents, and life insurance provides financial security for families left behind. Each type plays a crucial role in managing risk and providing stability during uncertain times. In summary, the Great Chicago Fire wasn't just an unfortunate event. It was a catalyst for modern risk management systems that have become indispensable to our daily lives. Insurance evolved from a niche service into a cornerstone of economic resilience and social security, thanks to one fiery evening over 140 years ago. The growth in insurance markets following the Great Chicago Fire led to innovations like fire-resistant building codes and safer construction materials. Companies began offering premium discounts for properties that met these new standards, incentivizing widespread adoption. This not only reduced future risks but also improved public safety. Furthermore, the Great Chicago Fire of 1871 highlighted the need for transparency and accountability in financial practices. Insurance companies began implementing more rigorous underwriting processes to ensure they could handle large-scale disasters without failing financially. These changes paved the way for stricter regulatory oversight of insurance markets, protecting both insurers and policyholders from fraudulent activities. The rise of reinsurance played a crucial role in managing catastrophic risks. Reinsurers take on portions of an insurer's risk exposure, allowing primary insurers to underwrite more policies and offer broader coverage options without fear of insolvency during major disasters. This system of shared risk has become essential for the stability of modern insurance markets. Today, these principles extend beyond property insurance into areas such as cybersecurity insurance and funds for climate change adaptation. As new risks continue to emerge in our rapidly evolving world, the lessons learned from historical events like the Great Chicago Fire of 1871 continue to shape how we manage uncertainty and protect ourselves economically and socially. This is educational and historical, not financial advice.